Hi, guys. Thanks for tuning in to another episode of Nuggets News. Today, we welcome a special guest to the show I've been wanting to have on for a long time, and some of you will know her. So, welcome, Lyn Alden. How you going, Lyn?
Hey, thanks. I'm good. Thanks for having me.
Yeah, you've been doing some fantastic work in the macro space. You're someone that I've learned a lot from in this complex world of how does QE work and treasury markets and this murky world, which even economists can't tell you how it works. And more recently, you've got into Bitcoin as well, which I just absolutely love. But for those that haven't followed your work, do you want to maybe give them your background and how you got into all this and what you do now?
Yeah, sure. So, I mean, my background blends engineering and finance. I've been investing, for a couple decades now. But my main career path originally was into engineering, and then I ventured more into engineering management, while also doing financial analysis on the side. And so I take a pretty quantitative approach to things. So I blend qualitative and quantitative analysis, and my approach overall is kind of fundamental investing, but then with a global macro overlay. So I look for companies and sectors and asset classes that I think are going to do well, based on going down to the micro level. Specific companies, specific, like Bitcoin or gold or whatever the case may be, while also kind of looking at the really broad picture of fiscal policy, monetary policy, things like that.
Yeah. And would you go, is there any sort of areas that you focus on, like with your macro backdrop, and you say, I think I'm bullish on gold, would you go down into gold miners? Are there sort of sectors like energy that you're focused on, or is it just a bit of everything?
A little bit of everything. So I tend to express a lot of my views through equities, precious metals, and more recently Bitcoin,
Yeah.
this past year. And so I do, for example, invest in precious metals, and that includes some of the miners and royalty companies as well. There are some sectors that I'm more familiar with than others. So I often go into commodities or energy stocks, whereas, for example, I don't pick out individual like biotech stocks, for example. It's just not an expertise I have.
Yeah.
And likewise, I don't go into some of the altcoins or other things in the digital asset space too much. My emphasis is on Bitcoin in that space. So I have to kind of choose my battles sometimes.
Yeah, absolutely. And I think for expressing the macro view, it's probably Bitcoin is the asset anyway, and the altcoins are a more specific tech play or little individual
Yeah.
narratives as well. So, um, I guess for people at home, we often talk about money, and we've had some fantastic chats with a range of guests about the misconceptions around banks, debt, and money. And Steve Keen loves to talk about this and say that they're on a different planet with the map that they've got. Do you want to maybe talk about how you, when you first learnt about money, and has that changed more recently in these murky waters of QE and the bailouts? These programs now, which people are arguing about whether or not it's money creation if the government spends into existence, or they print money to give as reserves, versus these newer models of maybe central bank digital currencies where we all have an account and they're going to give us money directly. So, do you want to maybe just talk about, for the beginners in the audience, how money works and why people get this so confused?
Yeah, money is one of those things that sounds simple on the surface, but then there's countless definitions for it. So, for example, for thousands of years, I mean, precious metals were one of the more common forms of money. Whereas for the past 50 years, we've been in this, kind of experiment globally where all currencies are fiat currencies, and that's what we normally use as our unit of account, what we trade with each other. I was somewhat lucky when I was a kid. For whatever reason, I ended up investing in small gold and silver coins. So when I was 10, I had just kind of this inherent learning experience with, comparing fiat currency that, pays you an interest, but also experiences inflation, compared to buying something that's inherently scarce and holding that as a long-term store of value that doesn't necessarily yield anything, but its scarcity kind of preserves it through periods of inflation. And so in this current environment, I had a recent article where I was pointing out a lot of differences between broad money and base money.
Mm.
So, for example, when you see things like central banks increase their balance sheet and you see those numbers go vertical, a lot of that, doesn't necessarily wind up directly in the broad money supply that people like you or me might have and go spend on things. Now, some of it can. So, for example, my articles broke down in what situations can that money, that base money, get out into the broad money. So, if you look at a banking system, it's kind of a two-layer system. So we all, have relationships with a bank, right? So we hold our deposits in the bank, and for the bank, that becomes their liability. And if you look at all the liabilities of these banks, so all of their commercial deposits, and then you include currency in circulation, that gets you to the broad money supply. That's what we normally consider as money. Now, all those banks, they do business with their central bank. So in the United States, all of those banks have they store their cash at the Federal Reserve. And so that's an asset for the banks, and for the Fed, it's their liabilities. And when you see like the central bank, balance sheet going up, what you're seeing is a lot of reserve creation happening. So that's an increase in, you can call it like the wholesale form of money. That's the money that banks, have as money. And then whether or not that gets out into the broad money supply that you and I use mostly depends on two things. One is whether or not banks are lending and therefore creating deposits, or if the federal government is running large deficits, and then specifically monetizing a lot of those deficits by the central bank, creating new bank reserves to buy that treasury issuance. So those are the main two ways that broad money supply increases over time.
So I think even just with what you said, a lot of people would be a bit shocked that banks don't hold their own money. They've got accounts with the central bank.
Yeah, pretty much. I mean, they hold a small amount of it as vault cash and ATMs and things like that, but the vast majority of their what they call cash is held in reserve at the Fed.
Yeah. And I guess people like Steve Keen have argued that this notion of like fractional reserve lending isn't even that true anymore. So, I mean, I still kind of refer to it as that. So when people come in and they deposit money and then the bank can lend out, well, ultimately, I think it's 10 times as much. But now they've got rules that they've changed these policies where you don't have to have those reserves. I've said, don't worry about it. Don't worry about those reserve ratios. If there was ever a run on the bank, for example, we've got your back. We'll just print money and flood the system. So, Jordan maybe talking about like someone like Steve Keen who says, "Oh, the fractional reserve system isn't even a fractional reserve," and how that's changed more recently.
Sure. Yeah. I mean, he does a lot of great work. I mean, I think he's a great economist. So there's a couple ways to look at it. So yeah, historically there were reserve requirements, meaning that banks had to hold a certain percentage of their deposits as cash reserves at the Fed, in case there's a run on the bank or just as a general risk buffer. And part of what the damage we saw in 2008, 2009 was because banks had extraordinarily low reserve levels. They were basically totally leveraged, and they didn't really have much cash reserves relative to either compared to their deposits or compared to their overall assets. And so you had a pretty small reduction in, loans going bad, and they become insolvent because they don't have that buffer of riskless capital, you
And
can
can we
call
just
it.
give people an example? For like in Australia, let's say Commonwealth Bank is the largest bank. They've got their deposits with the RBA, the Australian Central Bank. We head into a financial crisis. Your mum and dad have got maybe their investment property. They might want to sell that. Then they might want to pull the cash out and put it all in gold and silver. So it's that process, isn't it, of selling assets, whether it's shares or property or whatever, and then pulling money out of the bank. And when people are all of a sudden pulling a lot of money out of the bank and they've only got these very small fractions or ratios, then that runs dry. Is that the basic concept?
Yeah, I mean that's the bank run example. And so even during this year, I don't know if Australia encountered it, but I think most countries did, where there was a physical currency shortage, and that's because a lot of people were trying to withdraw currency at once. And so basically, if a bank has, they might have, uh, they have far more broad money. Like broad money is a much bigger pool of money than bank reserves, and that's the whole fractional reserve system we refer to. So it's mechanically impossible for large percentages of that money to be drawn out at the same time. And they kind of structured that on purpose because they don't print enough physical currency to even allow that to happen. So you start to get, banks have to just say no. You have to limit deposits to $2,000 per week, or whatever the case may be. You start to kind of run into those issues.
And I think we heard that,
And
didn't we, this year? Like we heard that in
yeah,
America that they were giving out coins even to the banks.
there were some strict limitations on deposits there for a period of time when a lot of people wanted to pull out at once. The other way to look at it is, so let's say you have a really big bank, so they might have $1 trillion in assets, and that consists of they have some cash at the central bank. They also have a lot. They own loans that it's other people's liabilities. So it might be their mortgage for their house. It might be a car loan. They might have mortgage-backed securities. They might have corporate bonds. Whatever the case may be, they have a variety of assets. And then offsetting that, they might have, say, $900 billion in liabilities. So that's commercial bank deposits that they owe to their customers, and other sort of liabilities that they have. Now, a bank is insolvent if their assets drop below their liabilities. So if you look at their $1 trillion in assets, if they were to have, if their assets go down by 10% because, mortgages don't get paid back, or personal loans don't get paid back, if that drops far enough, they're insolvent and they literally go bust. And so if you have, say, a 10% buffer, that's pretty big for banks. Whereas, going into the financial crisis, many banks had a low single digit cash buffer. So if their total assets fall by 3 or 4%, the bank becomes insolvent. And that's what we saw happen on a pretty wide scale back in 2008. And so there are, after that, they did all sorts of regulations. They said you need to hold more reserves. You can't hold 3% reserves. You have to hold like 10% reserves, whatever the case may be. As if you become a really big bank, the reserve requirements might be higher. Now, over time, some of the, every country has different requirements, right? So some countries have reserve requirements. Other ones, they say, okay, there's temporarily no reserve requirements. But, there's also the trickier thing of capital requirements. So it's not just how much cash you have, it's what is the overall kind of risk of your assets. So, for example, a big chunk of the bank's assets might be sovereign bonds. So, in the United States example, they might own treasuries, at U.S. Treasuries. And so that counts as part of their kind of overall risk package in a similar way that cash does. So it's, even when they're not specifically reserve constrained, they might still be constrained in terms of a capital requirement. So when you take into account their things that are defined as virtually riskless, like cash, gold, or sovereign bonds, they have to have a certain percentage of their assets in assets like that in order to not run afoul of regulators by being too leveraged to riskier assets like mortgages are kind of moderately risky. And then, of course, you get into riskier types of lending like credit card lending and things like that.
Yeah, and that's where we see that the idea of pristine collateral. And you mentioned U.S. Treasury bonds. Is gold's a tier one asset in most countries? Is that correct?
Yeah, the Basel three, I think, added that. So that didn't used to be the case, but now gold is treated at that top tier.
Yeah, and the other part where this gets interesting is the huge growth in the like commercial mortgage-backed securities and these triple B rated, and we hear about they're one tier away from junk status and they can't have these junk status in their portfolios. Is there also requirements to actually force sort of certain funds to buy a certain number of government bonds each year? So it's kind of this system where there's all these relationships and sort of it forces people to buy and support the bond market to some degree, doesn't it?
Yeah, I mean, in the U.S., we have primary dealers, and so their job is to buy, at treasury auctions, and then they can resell those treasuries at a later time. Now, if the foreign sector, for example, is not buying much, and even if the domestic, like non-bank sector, is not buying much, what we can see happen is that the primary dealers have to keep buying as long as they can do so. And so they start to get kind of filled with treasuries, and that can run into an issue eventually. I think, my work showed that was a big concern for what happened during the repo spike in autumn of last year, which
Yeah,
is basically that the foreign sector stopped buying treasuries. There was very large deficits. The central bank was not buying them at the time. They were actually doing quantitative tightening for a brief period of time. And so we ran into all sorts of liquidity issues in the banking system. And so basically the Fed had to step in and start creating new bank reserves to buy treasuries. So basically undo their quantitative tightening even before we had the pandemic hit several months later.
yeah, okay. No, I mean, I thought I had a reasonably good understanding of that, but I think the way that you've just walked through it there, that was fantastic. So I want to step people through it again that might not understand this. So what Lyn is saying is that the sort of the big banks have to buy the treasury. So when a government issues a bond, there's always a sort of a buyer there. But what happened last year, or even in Australia, this can happen when there's less overseas demand. Australian bonds aren't as attractive all of a sudden. Other countries are maybe worried about our currency going down, so they don't want to buy an Aussie dollar bond and get paid in Aussie dollars if they think the Aussie dollar is going to go down 20% in the next few years. So all these things come into play. Now, when that happens and these big banks are the only ones that are still buying, at the time we had the Fed doing quantitative tightening. So instead of like printing money, doing QE to buy more bonds, they were doing the opposite. So they were putting more bonds into the system when there already weren't many buyers. And so all the US dollars or fiat currency that these big banks have was being used to buy these bonds. And so when we have all these other banks, and we hear about the things like the swap lines and these all countries and banks, the financial system needing dollars outside the US, but the big banks that are part of that system, they're saying we don't have any dollars. We've been forced to buy these bonds, and that's when it dries up, and you see the spreads go out on all these interest rates. No one wants to lend to each other. There's panic, and is that a good definition of kind of what happened? And then the Fed start jumping in.
Yeah, pretty much. And it gets a little bit more complex than that because, for example, all through that year, hedge funds became a major source of buying for treasuries. So if you look back at the past 5 years of treasury issuance, so the foreign sector mostly stopped buying in about 2015. And since then, more and more of it was bought by domestic sources. So that was corporations holding T-bills on their balance sheet as cash equivalents, for example. That was insurance companies, pensions, individuals in their mutual funds, or their bond portfolio. And then towards the end there, we started to see a little bit of more foreign buying, but that tapered off right before the repo spike. And that year, hedge funds were large buyers as well. However, they go to the repo market to get financing, and so that the ultimately that showed up in the repo market. So hedge fund resellers, foreigners resellers, and you can't have a situation where overnight bank lending rates are like 7%, which is what we saw at the repo spike, while treasury yields are 2% or whatever they were at the time.
Mm.
And so that mismatch, basically the price of money became uncontrolled, and so the Fed had to step in if they want to keep the price of money down to low levels. And so yeah, they started out by fixing the surface level problem, which is they started lending in the repo market, and they said, okay, banks will lend to each other as the Fed, we will lend. So if we had a couple weeks of them doing lending to fix that and get that down to a low level, but that proved insufficient. So they had to start outright buying T-bills to expand their balance sheet and to take some of this excess supply.
And just, I guess, like, just broadly, so because people hear these things like, oh, they'll never be able to undo it, or the market is addicted to this. And what I kind of picture happening is whether it's Jamie Dimon saying, oh, we're not sort of interested in those treasuries as much, or we'd rather speculate over here. We don't really want to lend here at the moment. It's kind of like they have the best of both worlds. They can win, but then they never really lose. Um, does that kind of make sense as well? Like, they get to kind of pick and choose when they make money, when they don't. And I think what we got a glimpse of was like the actual maybe free market rate of money. And all of a sudden, when the Fed aren't intervening, well, rates aren't naturally 0% at all. There's quite a bit of risk in the system, and they jump to 7% or 10%, maybe 20% overnight in some places. Is that kind of like showing the cracks in the system and what would happen if there was like a free market? So when Peter Schiff says they'll never be able to unwind QE, the markets become addicted to this because they've placed all their chips in and speculated in different areas, and the money just doesn't flow back into this other spot that it would normally be in the past, does it? It's kind of already gone elsewhere.
Yeah, pretty much. I mean, that basically showed that without Fed intervention, that's what the rate would be for a while. I mean, but at that rate, the system would quickly start to kind of implode on itself. We saw a similar thing in March of this year when so we have, of course, had the giant equity sell-off globally, and many sovereign bonds at that point started selling off as well, which is unusual because usually, when investors are fearful, they plow their money into things like treasuries,
Mm.
and so you start to see yields go down. And at first, that's what you saw. So the bond market correctly front ran the equity market. So when the coronavirus started to get serious, for things like commodities and bonds started to sense it first. So you had the decline in those before the equity market. That's always the one that's late.
Yeah.
So bonds were rallying, stocks started to fall. But then when it got really bad in mid March, and just we had like those massive down days, we started to see the dollar spike in strength relative to the euro, relative to many emerging market currencies, relative to virtually every other currency, and you started to get that global dollar shortage play out. And so what happened was, some foreign central banks had to start selling treasuries to get dollars because they have a lot of dollar-denominated debt that they have to service.
Yeah.
Uh,
I'm going to
and
show
at the
this on the
same
screen just while you're talking, Lyn, because I really want people to understand exactly what you're describing here. So, yeah, you keep going and I'll
Sure.
bring up what happened.
Yeah, sure. So, basically at first the bond market was behaving as you'd expect, with bonds rallying while stocks fell. But when it got bad enough and we had that dollar spike, so foreign sector had to begin selling some of their treasuries to get dollars, And then of course that we had leveraged like risk parity funds, like hedge funds that buy treasuries with leverage, they had to start selling. And so we had a bunch of sellers in the treasury market, and so we actually started to see rates rise, meaning that bonds were selling off alongside stocks right at that heart of that crisis in mid-March. And worse than that is the fact that the treasury market pretty much became illiquid. Like it just virtually broke. Like the market broke. And so what happened there was basically that there was too much selling pressure, not enough buyers. And so the Fed came in and they bought $1 trillion worth of treasuries in 3 weeks in mid-March. And so that was another case where we started to see the actual supply and demand of treasuries play out if the central banks aren't taking a big chunk of those supply off the market, just because the supply was too big for anyone to handle, especially given some of the global dollar shortages that we saw leading up to that.
Yeah. My charts are playing up, Lyn. I don't know why they won't let me compare it, so I'll just show people one at a time. But this is basically the bond market here, and as you can see, it started like money started to go very very quickly into bonds as stocks here. Let's just compare it down the bottom. You can see here. So this is the US stock market. Let's get rid of some of this other stuff, and you can see that the money was flowing into the bond market quite quickly before stocks started to sell off. So let's just line these up here. Where are we? Start of March here, 19th of February, stocks are starting to plunge. Money's been going into the bond market. Oh, sorry, that's the same symbol. Let's get rid of that. Okay. I don't normally do this in interviews, Lyn, but this is like probably one of the most important concepts that I do want people to understand. Okay, so here we are. Money's going in February into the bond market in quite a big way. Anyway, I might do another separate episode on that. We do talk about this in some of our other episodes about the relationship of those money flows. But why do you think it was different this time with money normally going into bonds when people say, hey, I've made good money and my profits on my shares. Let's just park that wealth in a bond where I can get 1, 2, 3% and let's ride out the storm. So why was it different this time when people start to panic and go, whoa, I don't want to be in bonds? Is that because they say that there's going to be huge amounts of money printing? I'm holding a bond that's paying me out in US dollars. And that's what people are getting a bit fearful of now, isn't it? That they don't want to hold a bond and get paid in US dollars if they're going to be printing 20, 25% more dollars each year and being diluted. Is that kind of the general fears or?
So, I mean, that's the fear for some people. But in that environment, there was a lot of demand for treasuries at first. The main issue, the actual sell-off, was more mechanical in nature, in the sense that, you know, uh, uh, I think you probably had guests to cover this before, but going into that event, there was about $13 trillion in dollar-denominated debt held outside of the United States, according to the BIS. And there are other things we can add to that. That the number is actually probably higher than that, but that's the BIS's estimate. And so that means that corporations and sovereign governments around the world, many of them have debt that's denominated in dollars, which is tricky because they can't print dollars. That's a foreign currency for them. So that's an obligation that they can't print, and so they have this dollar-denominated debt, and many of them have foreign exchange reserves that they use to settle their debts if need be. And so what we saw, and they hold that in treasuries for the most part. They also, if they diversify, they might also hold it in other currencies, sovereign bonds, and some gold and things like that. But a large portion of it is treasuries. And so what we saw was, we had this big, shortage of dollars outside of the U.S. system. Now, we also saw in the U.S. system, but that's less severe because the Fed can easily supply, liquidity as needed, but it's harder on the international markets. And so that's where we saw the swap lines open. So trusted, ally central banks can get access to that liquidity. But we also saw that many central banks, they started selling treasuries in order to raise the dollars needed to supply their systems with liquidity. And so that is kind of a mechanical force selling. It's not even necessarily a decision like I'm worried about money printing, I'm worried about, the value of the treasury. It's more like I have to pay this bill next month. I need dollars to do it. And I have this big stack of treasuries that I can sell and get dollars. And so you had that kind of forced selling. And then you had hedge funds that, they hold, stocks and bonds risk parity basically is you hold a lot of bonds, you hold some stocks, and you leverage it up. But if you start to have both stocks and bonds selling off together while you're leveraged, it means that fund has to say, okay, we have to deleverage now, so we have to sell some of our assets. So they're just mechanically selling bonds as well. So you basically just had a lot of forced sellers, not necessarily people deciding to sell, but that they have to sell, and just not enough buyers at the time to pick up all that slack. So that's where the Fed came in and said, we'll literally buy, as much as needed. We'll buy $300 billion a week to reliquefy this market.
Yeah, and so that forced selling is all assets. I mean, that's why we saw silver go
Yeah.
down to, I think was it 1250 or something stupid. And you say, hold on, why is this asset at this price? And a lot of the
Yeah.
ETFs were trading well below like intrinsic value because people just had to sell anything because they're getting all
Yeah.
these margin calls. As you mentioned, the whole 60/40 traditional bond stock weighted portfolio and all these traditional ways to diversify, it's kind of out the window in these big macro events, isn't it? When a liquidity crisis happens, or even some degree these days, and it's a whole other conversation, passive investing, when there's just lots of money and people are just buying ETFs and money's flowing into the system, everything just kind of goes up at once, doesn't it? It becomes more correlated than in the past when there was more limited amounts of capital and investors would have to choose between bonds and stocks. Do you agree with all that and the way that it's really changed the relationships?
Yeah, particularly when you get down near the zero bound, which some countries have gone a little bit below the zero bound into negative nominal yields, which is historically new. But basically, when you get down that low, bonds don't provide the same kind of counter cyclical buffer that they do when they had higher yields. And also going back to the earlier point of why this time was different, basically, as sovereign debt gets very large, we start to kind of enter a different phase in the long-term debt cycle. So the amount of sovereign debt to GDP that the world went into this crisis is far larger than it had, 10 years ago or 10 years before that, for example. And that combined with the fact that, the global monetary system as structured, meaning that the petrodollar system, where all oil is priced in dollars pretty much, and most other commodities are priced in dollars. That's starting to run into kind of some growing pains, and we've had this kind of growing dollar shortage issue for at least the last 5 years, and it really kind of extends further than that. But basically, that made the whole system kind of a lot more fragile this time around than it normally is in past recessions. Plus, of course, you had the severity of the lockdowns.
No, it's so fascinating, and to me, it's kind of a little bit mystifying why the Fed or why other central bankers don't talk about this more. I mean, we kind of saw Mark Carney hint at it, didn't we, when he said we need a new reserve currency or a new system, and the US dollar is getting too much benefit, and this isn't working. More recently, they've gone from saying that crypto is this niche thing that's never going to affect monetary policy to saying, hey, we all need to do this crypto thing and central bank digital currencies are going to save the world. So I think they're starting to realize that the system's not working. But before we maybe get into all that side of things, you said that in around 2015, I think it is on the charts, like China and that became net sellers of US Treasury bonds, and the central banks globally have been pretty big buyers of gold. Now, just roughly, like using round numbers, the gold market's gone from maybe 10ish to 15ish trillion, and I know those sort of numbers are similar, aren't they, in terms of the bond market and foreign held US dollars, the shadow banking petrodollar system, euro dollar system. Is that sort of equal weights of money that's maybe going to gold that used to go into bonds? And is this just like geopolitical tensions, or are they not interested because rates are so low now? Or yeah, I just want to get your thoughts on that side of things.
I mean, I think there's a variety of reasons. So, it's not necessarily that they became net sellers; it's they just stopped accumulating at anywhere the same pace they used to. So they've mostly been holding it flat. And even if you have small increases, if it's not going up by as rapidly as treasuries are being issued, then basically the percentage of treasuries owned by the foreign sector goes down over time because they're just not keeping up with that issuance. And so, we saw this kind of play out as markets mature. So, decades ago, Europe was the big financier of U.S. deficits, so they run big, trade surpluses with us. They send us good, we send them dollars, and they take those dollars and they reinvest them in the treasuries. Then that started to mature, and we had the rise of Japan. So Japan kind of overtook them as the big accumulator of treasuries. and that also kind of came to an end eventually. And for the past 20 years, it's been China. China was the big growth engine. We started to run massive trade deficits with China, and so they got a lot of dollars, and they'd reinvest a lot of those dollars into treasuries.
Mm,
Now they made a strategic decision several years ago that it was really no longer in their interest to keep accumulating treasuries. So
mm,
they still held treasuries. They slowly kind of tapered a little bit, but they still hold a lot of treasuries. But instead, they started taking their dollars and buying hard assets around the world. So it might be commodity interests in Africa, for example. Just the Belt and Road Initiative, all sorts of different infrastructure, hard asset, commodity related things, rather than putting those dollars into treasuries.
mm.
And so that basically meant that the U.S. had to start self-financing a large portion of its deficits, especially because we're not seeing India or Africa or any other potentially emerging areas kind of take over as the fourth major financier of U.S. deficits. So that's kind of the difference this time, is that we've had this kind of multi-decade stretch of finding different foreign sectors to become our major financier, and ever since the past 5 or 6 years, we pretty much ran out of room there.
Yeah, and I just love that sort of thought process because it's things that I mean I've maybe stumbled across or discovered on my own journey, and I love the way you framed it there because on a macro sense, I think we've got India and Africa not really. Well, I don't know. I feel like they're not going to be as subservient to the US as maybe these other countries have. I know India is very much about very protectionist, and that is going to change the privilege that the US had because on the micro side of things as well, you've got the outsourcing of all this cheap labor. So the US kind of have these two privileges, don't they? And that really is changing. And once that stops, you end up in this situation like we're in today, where you go, well, hold on, they've got this $3 trillion deficit now, and if people aren't going to buy their debt, investors around the world are getting really scared about, well, hold on, the US dollar can't hold its sort of value if they're going to run these $3 trillion deficits, and the only buyer is going to be the Fed printing more money out of thin air to buy it.
Yeah, historically, when you have loose fiscal policy and loose monetary policy together, that's a pretty good recipe for a decrease in currency. And there's some argument that you could have a temporary thing. So if you look at previous dollar spikes, so the dollar, ever since it's been free floating for the past 50 years, there have been three major periods of dollar strength. So one was in the mid 80s, one was in the late 90s to early 2000s, and the other one has been in the present since 2015. And those are the three strong dollar periods. And in all of those periods, you started to get a lot of global tightness. And so foreigners would slow down their treasury purchases, and the U.S. would have to start kind of self-financing. And in some ways, that would kind of undo that cycle and start weakening the dollar. And when the dollar weakens again, some new foreign sector can begin accumulating treasuries again. So it's somewhat self-correcting. However, every time it's getting structurally more difficult, in part because after World War II, the U.S. was a very big percentage of global GDP. We were something like 40% of global GDP, and over time, even though our GDP's grown, the rest of the world's grown faster in the sense that you had Europe and Japan recovering from the war, and then you had the rise of China and other emerging markets, and so now the U.S. is a much smaller share of global GDP, and we're no longer even the biggest commodity importer. So that's China now. And so, the current system made more sense when the US was over a third of global GDP and when we were the biggest commodity importer. You could say, okay, we're going to price all global commodities in dollars. We're going to use our military to defend, shipping supply lines and that whole system. But now that the US is not even the biggest commodity importer, it's really hard to kind of keep this system as it's going. And we're starting to see cracks around the surface. So one, of course, is foreign sector not buying treasuries. We're also seeing some countries seek to de-dollarize their trade, and so like you brought up Mark Carney, for example, that there's starting to be kind of talks about this. Now, money's kind of inherently political, so you generally have allies, tread lightly around talking about global reserve currency status. But when you have nations that are less friendly with each other, that's when they can have more kind of direct action. So Russia mostly de-dollarized. Instead of holding treasuries, they've strongly wanted to hold gold instead. China's wanted to hold less treasuries. We've seen, for example, the trade between Russia and China. It used to be over 80% dollar based, and now it's something like 45% dollar based, even just a couple years later.
Hmm.
So more and more kind of these countries are finding ways to do trade using either the euro, using their own currencies, or just basically non-dollar systems. And I think also just technology is going to make that increasingly easier, whether it's stable coins, central bank digital currencies, all sorts of things can make that increasingly easy. We even saw, for example, recent news of Iran, looking into using Bitcoin to go around sanctions. And so all these kind of decentralized payment systems make it easier to go around these historic bottlenecks.
Absolutely, and I'm sure you've seen my cheesy name for the digital thick shake theory, which is just this concept that everyone has a smartphone and can download a stablecoin wallet, and as long as I've got access to any sort of crypto exchange, a centralized one that I sign up on, or even a DEX, a decentralized exchange on Ethereum, where anyone can swap one coin for another. So I can swap my Ethereum or my whatever coin to a US dollar stable coin. And so I was talking to Raul about this. You got to kind of go back up the food chain and say, well, where does that US dollar stablecoin originate? And yes, there are the stablecoins that originate from the US that are fully regulated. When Coinbase has to, or the Gemini, the Winklevoss twins have to issue more of their stablecoin, they've got a close relationship with the US bank. They have more deposits, and that kind of works nicely. But we also have all these synthetic dollars, which are just pegged assets. So in theory, there's no limit. And I think this is what I maybe didn't explain clearly to Raul, because I was trying to get across to him that there's no limit on how many synthetic dollars you can create as long as they're backed by something else in this crypto world where we can do that. And I really think that just changes this whole dynamic. Oh, there's a dollar shortage. Well, no, anyone can create synthetic dollars from anything digitally. Do you have any thoughts on that?
I think in the long run, that's a factor. There's different types of dollar shortage. So, for example, if you're an emerging market, like say Turkey, and you have a lot of dollar liabilities in your corporate sector, but you don't have a lot of treasuries in your FX reserves, that's when you start to run into a currency crisis, like we've seen from Turkey, where their currencies devalued quickly.
Hmm.
Now, even if they had technology to get dollars readily, they still have to basically print lira in order to get dollars, and so that process of acquiring dollars inherently weakens their own currency, and then you can have a spiraling effect. However, if you are trying to use kind of systems or different kind of systems that don't go through New York, for example, if you're worried about sanctions cutting you off from these key systems, that's where things like stable coins can help. And then the next step forward from there is some countries being able to use their own currency to buy commodities or things like that. So, for example, with China and Russia, it goes a step further than just avoiding New York-based financial systems. It's avoiding the dollar, more specifically. So they're either using the euro or their own two currencies to trade things like energy or technology between themselves, at least in part. And so yeah, that's a big push also from China's digital currency is that as the world's biggest commodity importer, they have an interest in being able to import some of their commodities using their own currency rather than having to acquire dollars and then using those dollars to acquire those commodities.
Yeah, and we saw Venezuela try and push the idea of this petro digital coin as well. I think we've seen different countries settle trade in gold. Definitely Iran in Bitcoin. That is just such a headline story. Um, I'm waiting for all the bad articles to start coming out from the US about how bad Bitcoin is because Iran can do this. But I think that going forward, China are going to push really hard because imagine if they start to have sort of a new commodities exchange, and I know they want to get into the gold market. I think they're trying to like settlement of the gold price and the manipulation from London. I think we're going to see sort of a
They
China's
have, yeah, they've had an increasingly successful gold exchange there.
yeah.
So that was one of their earliest phases, and now they're of course they're moving into the digital currency space.
Yeah. I think I remember reading about it. So there you go. But I think if they can settle with like a gold digital yuan pair, and people know that they can go to this Chinese sort of digital exchange from anywhere in the world and settle their trade in, that's when China are going to try and make the digital yuan more of a reserve currency. It's going to keep capturing market share, even if it's not officially a reserve currency. And I think that's where, again, the digital world just starts to surpass the IMF. And the IMF say, well, no, China, you're not a bigger part of the special drawing right basket. And China say, well, you can make those rules and say what you want, but we've got this exchange and the amount of people trading with us is going up. And they start to just circumnavigate that whole US system and SWIFT system, don't they?
Yeah, my overall base case is to look for an increasingly multipolar global reserve system. So people often ask, like, if the dollar is going to lose some of its status as a global reserve currency, what currency could possibly take it? I mean, would it be the euro? Would it be China? And my view is no. I mean, going back to the original point of the U.S. is no longer really big enough to be the global reserve currency. So our percentage of GDP has decreased relative to the rest of the world over time, and it's still the case that there's no other currency block that's big enough to be the single global reserve currency for the whole world.
Mm.
Instead, what I think you're going to see is increasing decentralization and kind of regional global reserve currencies. So instead of China trying to take the same role that the dollar had for the past 50 years or more, their main interest is being able to buy commodities with their currency. And so I think you could definitely start to see that serve as regional reserve currency in a limited way. And same thing with the euro. While the U.S. Has a smaller share of its treasuries owned by the foreign sector, it starts to kind of pull away a little bit and shrink relative to, as a percentage of global assets that are held.
Well, let's just extrapolate this a couple of steps, and let's just go straight to, does Bitcoin in theory solve that? If Bitcoin was a multi-trillion-dollar market cap, you're saying these individual countries and economies, it gets messy for a number of reasons, whether it's the size of the economy or political reasons, as well as the actual system itself, which isn't working. But in theory, if Bitcoin's at this multi-trillion-dollar market cap, it's apolitical, it's digital, and it's easy. Maybe that can be the pegged or the denominated asset for which all these other commodities are traded in. Does that, in theory, solve a lot of problems?
In theory, yes. I mean that goes all the way back to the idea of the SDR or the Bancor. So when the Bretton Woods system was constructed, which was that the dollar is backed by gold, other currencies are backed by the dollar. That was the competing idea to that, because there were people that pointed out decades ago back then that this would eventually result in all sorts of issues decades down the line, and that's what we're starting to run into now. So, for example, in order to support the global dollar system, the U.S. has to run massive trade deficits and basically export its blue collar, supply chains and workforce, and that creates all sorts of social issues and economic issues. And so back then, one of the alternative options was the idea of a bancor, which was that we'd have like a unit that's a basket of global currencies, and that would serve as kind of the world currency, and that would kind of that'd be the medium of exchange internationally for major settlements. But that idea did not win out. The globe, the Bretton Woods system run out, which eventually transitioned to the petrodollar system. And now we've seen increasing attempts to kind of look at that. So we've had the digital kind of SDR idea floated, and even in a private sense. So, for example, Facebook's Libra is kind of a replica of the Bancor, but from a private company, and that's still kind of in limbo. Or you can see stable coins, or you can have a neutral reserve asset like Bitcoin, for example, that can serve in that role as well. And I think it's hard to predict which way the world's ultimately going to go. It's probably unlikely that they're going to work together to say expand the use of the SDR. So instead, you see a couple different outcomes. I mean, Bitcoin is an example of a trustless asset, so there's no kind of cooperation required. Just
Yeah.
as groups decide to use it, it can potentially grow market share. Or, like I said, you could have regional kind of digital currencies that are used in trading blocks. And I think that it's hard to predict which way it's going to go. But I think to your point, in theory, yes. I mean, Bitcoin can serve as a neutral asset for any parties that choose to use that for trade.
And that's where you hear Raul talk about it's the ultimate reserve asset for these reasons, because you don't have to worry about, well, what's Bitcoin's debt? It's debt to GDP. Has it lost market share? Who's the president of Bitcoin and what are they tweeting at the moment? All those things go out the window with this apolitical global system. So I love to think about that long term. And I kind of feel like I'm often hearing people describe all these issues and saying what we need, but they don't join that last dot and then say you're almost describing Bitcoin as what we need, but they haven't just sort of got that final step yet.
Yeah, I think things like that can come in time, because right now Bitcoin, even though it's growing, is still a fairly small market cap when it comes to global trade. So I think if it continues to do well in each halving cycle, eventually you could see more countries choose to put part of their reserves in it, or to price things in it to try to go around dollar-based systems. So either that or other stable coins or different types of technologies that all can make trade easier.
Yeah, and just again, I just people might not know. So SDR, when Lyn and I say that, that's a special drawing right that the IMF, the International Monetary Fund, come out with this like it's not really a thing that you can hold or go on holiday and spend, but it's this concept of a basket of currencies and they have different weightings. And do you know Bancor is like a crypto project and they have this like they sort of peg. It's the same concept as what the Bancor originally was. So crypto crowd watching this video, that's where the name Bancor actually comes from as well.
Yeah, I'm
Um,
not surprised that someone would adopt the name. And yeah, and so an SDR, as you pointed out, is a basket of global currencies. Several of the major ones, like the dollar, the euro. Several of those top currencies. And it's instead of being a unit that you or I might get, it's something that central banks hold. And back decades ago, there was this idea to kind of globalize the reserve system, but it never really took off. So it remained a very small percentage of central bank assets.
I mean, the other thing that I kind of like to just think about when I'm doing my meditating and where is this all going? Now that we're going more digital, in theory, you could have a special drawing right, which was all currencies around the world, and it's all automatic or it's AI driven, and then those little currencies are actually backed by the commodities in that country, and you can get so funky once you start to tokenize and fractionalize and sort of AI everything. So that's where again, there's a lot of potential here in the crypto world. Um, One thing I was going to say, Lyn, yeah, so with the cycles, I think the ultimate bull thesis you could make for Bitcoin is I think we're going to about 100K just with the path that we're on now in the next cycle, the next sort of 5 years. And then from there, it becomes, well, it's to this size now where it is really starting to compete. And stablecoins would be a massive market cap by then too. And so you've got this crypto system that's really starting to compete with this other system. And I think the fact that one system is sort of fractionally backed and this other is, it's not debt related, it's not someone else's liability, that makes the other system so much more weaker as well. Like recently, you saw them come out and say that banks custodying stablecoins is actually a huge risk for them. But I won't get into that. It's funny that they even say that because they said in the same sentence that crypto stablecoins have to be backed one for one. So there's zero risk of a collapse with that happening. But where I'm going with this is in the following cycle, it might actually solve a lot of their problems. So when we're at $100,000 Bitcoin and they say we need to ban this, it's getting so big, they might be to the point where it's literally we need something, a new system so badly that the next cycle after that it goes from 100,000 to say a million per Bitcoin, and we're at this $1 trillion market cap. And at that point, it does solve a lot of these issues, which might be far worse at the time. So, I mean, that's maybe I'm dreaming a little bit, the ultimate bull thesis, but there is sort of a path to that price point and market cap, isn't there?
There are paths for that. I mean, currently the market cap's over 250 billion, and overall, global assets are something like 400 trillion. And so for every quarter of 1%, that's $1 trillion. And so Bitcoin is still a very small percentage of global assets. So if it does continue to do well in each halving cycle, it still has a pretty big runway ahead. And I often compare it to gold. So gold has an estimated market cap of something like $10 trillion. And so large portions of that are held by central banks. Other parts are held by private storage as coins and bars. Then of course you have a large portion of it held as jewelry. And especially in places like India, a lot of that is specifically it's jewelry and it's wealth storage.
Mm.
Whereas some other cultures think of it a little bit differently. And so it is possible that Bitcoin does have a pretty big space to potentially fill into if it does continue to do well in each halving cycle.
Yeah, and I think that's why I'm also bullish on gold because it's a lot easier for gold to go from 10 to 100 trillion to actually help the system. Again, there's the conspiracy theorist out there or the big banks that are getting fined for manipulating metals. I just think that the system always forms some sort of equilibrium, and whether there's been price suppression or not, things are going to come back, and gold might actually help the system. Having the partially pegged gold and central banks that have got this gold, they can start to re-stabilize. Well, what is everything worth? Because I've got this thesis that now that we're in the money printer go brr era, where everyone is just printing a lot of money, And you said that China have stopped buying as many bonds and they've started buying more gold and commodities and those types of things. And I start to question, well, how much longer, when country A doesn't know how much money country B is printing, do they keep selling their commodities? And people say, well, China's bought up too much real estate in Australia, or, we're buying too much oil and uranium or whatever it is, all this global trade that's happening. How long does it just keep happening when country A doesn't know or trust country B how much money print to go brewer they're actually doing in the background?
Yeah, and especially, I mean, the way that the game theory works is that countries start to have a competitive devaluation. So if the U.S. weakens, then Europe wants to go and say, no, we want the euro a little bit weaker too. We don't want the euro to strengthen too much against the dollar, and therefore make our exports less competitive. And then China says, well, now both the dollar and the euro weaken, so we want to print as well and weaken us, so that our exports don't become uncompetitive. And then the dollar does it again. So you have this kind of round the table devaluation. And historically, if you look at the long term debt cycle, after the zero bound is reached and you start to run into asset purchases, usually the end result of all that is some degree of currency devaluation. So that could be, you can compare it in different ways. So historically, it's been against gold or against hard assets in general. But that would extend also to other commodities. That would extend to real estate. That would extend to assets like Bitcoin. Anything that's kind of scarce. If you have a much larger number of currency units in the system, you end up getting a devaluation of the individual value of each currency unit.
And do you agree that we are sort of very close to that point now? I mean, what do they say at these big G20 meetings when they're all printing money? And the RBA, I mean, I speculated 2 years ago that the RBA would literally have to join the party, and it's exactly what's happened recently. For the RBA to do $100 billion of QE because the currency is starting to creep too high and other reasons, it is that he perfectly exemplifies the problem. And they're all sitting there at this G20 meeting saying, we're all printing literally trillions of dollars now, and we're not really getting anywhere because one goes up, the other goes down the next day, and no one really wins. And ultimately, the price of everything else just goes up. In some ways, that's what they want. They've committed to higher inflation. They can't get inflation, and they're saying, well, let's move the goalposts and try and get 3 or 4% inflation. If they're all printing trillions of dollars, then the price of all these items on the price on the screen and at the supermarket is going to go up. But I mean, does that help anything?
Well, it depends on whose perspective you look at. So if you have a very large amount of debt in the system relative to GDP or relative to currencies. Now, in a normal, kind of short-term debt cycle, you have a deleveraging. So you have, debts default, they get restructured. So you have debts go down a little bit. So that's how you alleviate debt as a percentage of GDP or as a percentage of money supply. However, at the end of a long-term debt cycle, usually debt gets so high that when they try to deleverage it, it starts to kind of result in a deflationary spiral. And so that's when you have, currency devaluation happens instead. So the other way to devalue debt relative to GDP or relative to the money supply is to dramatically increase the money supply.
Mm,
And that's what we saw back in the 1930s and 40s, and that's what we started to see in the 2010s and here in 2020s. So it doesn't initially start in rapid inflation in consumer goods. It initially starts devalued relative to asset prices, so relative to things like gold or real estate or stocks. And that's the phase we've seen pretty extensively. So, most currencies have devalued compared to gold over the past 10 or 20 years, pretty extensively. And that's extended to stocks, that's extended to real estate. And even, if you go back 20 years, even to many other commodities like copper. And so you start to get that devaluation. Now, if that continues and picks up pace, that's when we start to see inflation in broad consumer goods.
mm,
So, to some extent, that's been offset by offshoring and things like that. But that trend is probably reaching its apex. I mean, technically, if you look at global trade as a percentage of global GDP, that actually peaked back in 2008. So we had a multi-decade trend of increasing global trade as a percentage of global GDP, but that plateaued about 12 years ago, and so we've kind of hit peak globalization, and now we're kind of all looking at reshoring some of our own supply chains,
mm.
especially COVID showed how vulnerable some of these supply chains are, and so we have that trend in place, and so definitely I think going forward you could potentially see higher consumer prices for everyday goods if these large monetized deficits continue. let's call it, 5 years in the future. It's hard to say exactly when that's going to begin. And it's certainly already happened in, many areas, like in the United States. We have the highest healthcare cost in the world per capita,
Yeah.
and it's going up at, like, 4, 5, 6% a year, even as, the official CPI is, like 1.5% or whatever the case may be. So we see deflation from some categories like electronics and other things like that, but we see inflation in, childcare services, healthcare services, education, things that are hard to offshore. And so if you start to get that offshoring trend start to pull back, you could more easily see kind of increasing prices on everyday goods.
Yeah, no, I completely agree with that. When we hear these inflation versus deflation arguments, that it's the cancel on effect as well, where it's the money, goes to the banks first, the rich get richer, and we've seen this appear in things like inequality. Um, Now, it does change if central banks or governments start doing more of the universal basic income or stimulus checks directly to people, because that gets the money into the real economy, chasing fewer goods and services. That can cause inflation. But whether or not they're going to go down that route or keep doing what they're doing with the QE and, well, in Japan's case, buying other assets off Wall Street and financial markets, it's just this tangible versus intangible concept that I think that is also changing. And that's where maybe I believe that we are on a commodity super cycle, bull market doorstep, because the people are going to really start to chase and value real things, because no longer is it much good to you to have Apple shares that are worth trillions of dollars. If the price of food and everything is going up, you're going to start to say, well, hey, I need these real things.
Yeah, I think so. I think, I'm pretty bullish on commodities with a 5 to 10 year view. And if you look at, we had a supply glut in many types of commodities. So, for example, the unprofitable shale boom in the United States, all this cheap capital, willing to get oil out of the ground without ever making, without ever being free cash flow positive. That's
Yeah.
added to a lot of supply. So we've had a supply glut in oil and gas. And then, for a little while there, we had, for example, a copper surplus. We had tons of exploration in the past decade, and so we had this kind of, this pretty good amount of supply. But going forward, copper is starting to become more scarce. So we've mostly already worked out around through that supply glut. Now, the pandemic made oil and gas, that was, a big demand drop this year. So that's on a later schedule. But that's as we come out of the pandemic. We've already had, for example, a lot of capex cuts this year. So as we come out of that, you could easily see, a tighter oil and gas market. And so I do think, if you look out several years, you are probably going to look at, pretty good commodity prices. And if you combine that with that reshoring trend, that can be some pro-inflationary forces potentially.
Mm. Just quickly, the idea of the euro dollar system, where we have all the dollars outside the US, you mentioned the swap lines already. The numbers get thrown around about whether or not that's 10 or 20 trillion, but the demand, it's really hard for the Fed to ever meet that, because they commit $3 trillion to helping the US, and it sounds like a huge number, but it's always never going to be enough to meet the real demand. Is that kind of like the way I view it? Is there's just such a strain on these emerging markets to try and get the dollars and to pay down the debts. The system is just never really going to work. Like, it's never going to have surplus dollars in that external system. Do you agree with all that? Like, it's just always an uphill battle for these emerging market currencies once they get in a huge amount of US denominated debt.
Kind of. It goes in cycles. So when the dollar spiked in the mid 80s, the region that was most negatively impacted was South America. And so they were the ones that had those big currency crises back then. And in some ways, they never fully recovered from that. But when you have, the eventual weakening of the dollar, that's when you start to see kind of an emerging market boom, because their debts, get kind of deleveraged relative to hard assets, relative to their own currencies, and you start to see kind of more credit creation. But then that builds up to the next cycle. They take out so much dollar denominated debt that eventually they cause the next dollar spike. And so when we had the dollar spike in the late 90s, it was Southeast Asia that took the brunt of that,
Mm.
and Russia. And so you had issues happen there. And we a lot of those areas strengthened after that. So if you look at, after that late 90s, early 2000s, emerging markets crisis, then you had a dollar weakening, starting from the early 2000s, and you had that emerging market boom that happened. The idea of bricks are going to take over the world and become the big economic engines that started to take off throughout the 2000s,
Yeah.
and but then we had another strengthening dollar cycle, and so this time around places like Turkey and Argentina, Lebanon, they've been impacted the most negatively. Whereas, for example, some of the countries that were hurt the most by the previous dollar spike, such as Thailand and Russia, they kind of came into this cycle far more prepared because they have very high FX reserves relative to GDP. So they have kind of learned their lesson. So now they have more fortress positions. So you always kind of see that the weakest markets are the ones that end up struggling in that environment. So Turkey, for example, did not they came into this with a lot of dollar-denominated debt, and they did not have a lot of FX reserves. So they were the ones that were caught vulnerable this time. And so you tend not to see this. Some of the emerging markets tend to make the same mistakes over and over again. But most of them, they're not the ones that run into the problem in the next cycle. Usually, they were hit so hard by it that
Mm.
they, prepared for it. So you don't see Russia and Thailand running into the same problem this time. Instead, you see it showing up in places like Turkey. Now
Mm.
there are cases like Argentina that have been more repeated issues.
Yeah. Yeah, and that's the international situation. I guess in America, in their own backyard, or individually in Australia, if you think about our position, we hear the 3Ds, so all this debt, the demographics of the older people that are retiring, so they spend less. There's a big trend there for the first time in history that they're going to be big net sellers of a lot of the most commonly held stocks. And it's a little bit like anything really, when everyone is a buyer, and in the superannuation system or the retirement system in America, when everyone is buying these shares, and now we're to this point where the ages and the demographics are changing, that there's a large amount of people that are going to start to be those net sellers. So that there's a lot of deflationary forces. You mentioned technology. Um, I think decentralization is another one that's maybe not been spoken about so much. The idea of moving out of the cities and just the whole like centralization and corporate structures of money. I think that is kind of changing as well. So there's a lot of deflationary forces, but central banks are never going to allow that to happen, because if the economy is shrinking, there's less money, then and we need to pay down 300, 400 trillion of debt, they're just not going to risk that. So they're always going to print money, and that's where you can build these bull cases around gold and Bitcoin, because no matter what scenario we're in, whether it's inflation or deflation, it's sort of there's only the limited tools that they have, isn't there?
Yeah, because you have the structural deflation, and then you have the inevitable policy response that's more inflationary. And a good example is that was when the Treasury market broke in March. So you had this big deflationary crunch happen around the pandemic. So you had just massive inflationary response of printing a ton of money, buying bonds, and countering that force. So we saw inflation expectations as measured by the Treasury market collapsed and then shot back up. So if you look at the tips market, right? So in treasury, expectations collapsed and then just immediately went vertical back up to where they were pretty much as soon as that whole liquidity just got injected into the system. And so deflation would be normally a good thing in a lower debt and economy. So it's a good thing if your currency can due to productivity increases and technology and other factors, if each of your dollars can go and buy more goods and services, that's normally a good thing. But we've kind of structured our economy around the idea of persistent fast growth. And that's, we've mostly had that for the past 50 or 100 years. And we're starting to run into demographics issues and other things that are kind of making that no longer appropriate, but we still have the debt structured as though we're this rapidly growing system. And so there's definitely going to be some sort of reset, whether or not it's involving some sort of currency devaluation that could take multiple forms. And then after that, hopefully they structure things in such a way that it's just less fragile and more kind of optimized for the environment that we live in terms of demographics and development and things like that.
Yeah, and without even going into like renewable energy or any of those themes, it's just this idea that we're on a finite planet and that the system is built around this growth. And rather than realizing that, hey, maybe we're reaching the limitations of this system, they're doubling down and saying, oh, we need to get 3 or 4% inflation because that's what our debt-based system needs. But actually, in reality, we're not gonna get that. So I mean, what do you think happens next, Lyn? It's just 2020 has been a crazy year, but I already feel that in some ways the whole pandemic is just like almost a cover up for what's happening, because they were talking about climate change and central banks needing to save us from that. But even before that, we had the repo market and the cracks were showing up. So we just have to change. Like, this cannot go on the way that it's going. So where do you think the US is headed, where people aren't buying as many bonds and the Fed are reluctant to step up and just buy another 3 trillion of bonds, but they see the economy and people losing their jobs? With the elections hopefully will nearly out of the way, and we're going to get some stimulus and spending there. So, what happens next? Is it massive government spending and the central banks step up to the plate and buy all those bonds? Or do you think we go down the modern monetary theory path where they say, no, let's just spend and let's cut out the worrying about the central bank? Or which direction do you think that things are heading?
I think it'll differ in different parts of the world. So, United States, Europe, Japan, Australia, China, all these markets have different kind of political systems that make different things possible or harder to do. So, for example, Europe faces a lot of gridlock because, a bunch of nations kind of unified together under a common currency system. That's an inherently hard system to make these big changes to. Whereas, Japan, for example, is more unified. They can potentially do things quicker, and the United States is somewhere in the middle. So my base case over the next several years is probably to see some form of yield curve control. So we already have that in some degree in Japan and Australia in a very limited sense. In the United States, we have to go back to the 1940s to see the last time they did that formally.
Mm,
So the last time that U.S. federal debt to GDP got this high, the only other time in history was during the 1940s, during World War II. And they basically did wartime MMT in the sense that the Treasury worked closely with the Federal Reserve, and the Federal Reserve bought as many treasuries as needed in order to stop them from getting out of control. So what
mm,
they did was they said, okay, all treasuries are going to be priced at 2.5% or less yield. So the T bills are like 0.38%. The longer duration stuff is going to be 2.5%, and we're gonna create reserves as needed to buy treasuries to peg that yield. So
mm.
whatever the market wants to do, we're going to override that price.
Yeah.
And so you had this, you had multiple double digit spikes of inflation in the 1940s. We still had treasury yields held at 2.5%. And so as a result, anyone holding cash or holding treasuries, they got all their money back, but they lost in terms of purchasing power. And so I think, going into the 2020s, I think we're probably going to see more of that happen around the world, where central banks are formally holding their yields of their sovereign bonds below the prevailing inflation rate. And so the overall, result from that, so they can control the interest rate, but the release valve ends up being the currency strength. So you start to see, currencies devaluing, first versus financial assets, whether it's gold or real estate or Bitcoin or fine art, whatever the case may be.
Mm.
And then you can start to see that potentially show up in broader prices as well.
Yeah. Yeah. I mean, I just can't believe how quickly the central bank digital currency conversation has progressed as well as a possible solution. Um, I mean, do you have any thoughts on that other than, yeah, it is a system, it's just a minor upgrade because there's already currencies that are all digital, and this is just going to give them a little bit more power to firstly monitor everyone, but secondly inject money directly to, Lyn's account or Alex's account when he downloads the app. Do you see that huge competition for the retail banking system, and they're going to be scared of that, or what do you see playing out there?
Yeah, I think so. So, a lot of the changes we saw, happen this year, they didn't require, for example, changes to the Federal Reserve Act in the United States. So we didn't see kind of official, direct debt monetization. Instead, we saw this continued using the existing framework they have, which is indirect debt monetization.
Mm,
And whereas something like, people having accounts directly at the Fed with a central bank digital currency, that would probably require a change to the Federal Reserve Act. So that's going around the commercial banking system more directly. So they can already go around the banking system if the Treasury and the Fed work together. So if the Treasury sends out everyone a $1,200 stimulus check, and then they issue Treasury bonds to pay for that, and then the Fed buys most of those bonds using the commercial banking system as the pass-through entities, that's already basically MMT.
mm,
But there are central bank digital currency concepts that can make that more direct. But so if you're looking at it from the perspective of a central banker, of course they want technology to give as many tools as possible. They can do more fine control of interest rates. It more easily allows them to have a more cashless society. They can potentially do kind of stimulus checks even without Congress approval. But from the other side of it, that opens up privacy concerns. That opens up all sorts of centralization issues. And so I do think that's probably going to be a factor. Some countries are slower to do it than others. So, for example, China, they also want to make their currency more usable in terms of its regional partners in terms of commodity acquisition. So they kind of have multiple other ways of doing it, whereas entrenched systems like the Fed are more likely to be slower to respond because they're the ones that are kind of ruling the existing system. So they're less likely to kind of eat their own system and go with a new system.
And do you think just mathematically with the deflationary effects and what we've just spoken about that we are heading towards a universal basic income? It's just a question of whether the government sort of funds that or the central banks or as particularly technology is just so deflationary. There's just not going to be as many jobs, and when we're not to the point where we're even having this conversation yet. Do you think that the cost of living and all that's starting to show up in inequality? It's just like it could literally be in the next 12 months. Well, we've already seen, I guess, trials in some countries, haven't we? Do you think that's inevitable? Or?
So I think it showed up this year in the form of stimulus checks and other things, extra unemployment benefits, with COVID as the cover. So it doesn't really start without a crisis, right? So when you have a crisis and you have millions of people out of work, you say, okay, we're basically going to do temporary universal basic income, right? So everyone that needs it's going to get this capital injection. It's happening in the U.S. I have Canadian readers, for example, telling me of their system where they're getting checks every month now because their business is impacted, and so it's ostensibly temporary. But yeah, it starts out as kind of a temporary issue, due to a crisis. On a long enough technological timeline, you could start to see some of those systems become more permanent. Especially, we have to look at automation of driving or things like that. So historically, whenever you have technology advancements, it destroys some jobs and creates other jobs.
Mm.
Now, the big question going forward is, is AI and machine learning and automation going to get powerful enough that it destroys jobs without creating enough jobs? And so, if that kind of structural job loss becomes an increasing reality, I think you're going to see probably more and more political calls for some sort of universal basic income or other things like that. But it's hard to judge the timeline other than pointing out that it usually starts under these temporary measures, and we see from there how structural it could become.
Yeah, there's the famous saying that software is eating the world, and really, computers and robots can do anything that people can do, and the cost of technology and the unlocking of energy, it's just all heading in this direction where it's going to create new jobs, or let's call them tasks. There's always going to be new tasks, but those tasks are going to be done, I think, by software and robotics and things like that. So it might not create an actual job for a human being. And that is where it gets very interesting. I guess a good segue from the talk of stimulus checks and central bank digital currencies. When everyone got their $1,200, we saw a huge spike in Coinbase purchases of $1,200 worth of Bitcoin that day, and Ethereum actually. But yeah, what was your trip into the crypto world and down that rabbit hole like, Lyn? Like, were you someone that thought that this was all nonsense a few years ago, and why are you so bullish on it no, publicly now?
So yeah, I've had a couple touches with it. So I first heard about it in 2011. So I had a friend that mined Bitcoin on her computer back when that was possible, and I just thought like, oh, that was cool. Maybe I should do it. And I never got around to it. And of course, that was probably left like six figures on the table by not doing that or more.
Eight figures, I
And
reckon.
Probably, yeah. I mean, it depends how early it was. I don't remember exactly what time frame, but uh, it's just kind of a neat thing. I thought it was neat, but then I just wasn't really paying attention to it. In 2017, when we had that big parabolic run up in Bitcoin, I started to get increasing questions about what I think about it. So in the autumn of 2017, I published a paper on it, where I kind of analyzed it pretty thoroughly, and my overall conclusion was neutral in a sense. I was kind of neutral to slightly bearish in the sense that I said, it's a really cool technology. That was at the time when we were having, Bitcoin Cash spun off from Bitcoin. We had the rise of altcoins, so we had decreasing Bitcoin dominance. So my view was, okay, the technology is really cool, and Bitcoin is scarce. But is this whole space going to become so diluted that it's okay that Bitcoin's scarce, but if there's like 18 Bitcoin clones and the community gets split, what's going to happen there? And there's also, of course, very euphoric sentiment at that period.
Yeah.
And so I was like, I wasn't saying it's, like I didn't really criticize it too much, but I'm like, I'm not going to take a position. I can see why people would want to have a small position. Just be careful because, I see a lot of risks here. And of course, the next 2 months, we had that parabolic bubble and then a pretty big crash. And so it had like a 2.5 year consolidation from that point. And I continue to monitor it to see how it's, see how it's going. And I started to get more and more interested in late 2019, early 2020, and when it had that big dip in March and April, that's when I pulled the trigger and I said, okay, there's enough kind of bullish indicators here that I want to get in now, because at that point, I got in at in April at around 6,900 for Bitcoin, and it was actually like the same price as I analyzed it back in late 2017.
Mm.
Uh, but so the fundamentals were much improved. So it already had this big consolidation. I was looking into the halving cycle and saying, okay, this is historically a more bullish period with a supply reduction coming. I felt that the ecosystem is stronger. So the market kind of chose Bitcoin over Bitcoin Cash and these other things that the community could have split more, but it mostly didn't. So it kind of hardened Bitcoin's network effect,
Yeah.
and we started to see the ecosystem around it, the companies that all the different access points, the institutional grade custodians, things like that, make it easier for money to flow into it. So basically saying, okay, the price, it kind of underperformed, but now, I became very bullish on it, and so then I wrote a public article on it in July, and it was about 9,000 then. So I kind of further elaborated my case because my initial, if you kind of look at my progression in 2017, I was like, I'm not really going to buy it. And then in April of this year, I was like, okay, I'm going to buy a small amount. I'm pretty bullish on it now. So that was in my research service. And then by July, I was like, okay, here's my extensive, like, kind of full, like 8,000 word thesis on why I'm pretty bullish on it now. So I increasingly just kept researching it and getting more and more bullish on it the more I saw.
Did you watch our 4 year supercycle video, Lynn?
I don't know if I saw that one. I started to see a lot of there was like Plan B charts, right?
Ah,
And
yes.
so a lot of people debate about the whole stock to flow model and how valid it is. And so for me, it's not the actual like price targets that interest me. It was showing how kind of how consistent Bitcoin is around the halving cycle. So and then the logic of why that is, rather than just seeing okay the chart makes sense. It's saying okay here's actually why it happens is that new supply gets cut in half, a lot of existing supply is being held in strong hands. And so if there still is demand coming into it, it just pushes the price up. And then you start to get momentum chasers and more interesting and kind of increases demand. And so seeing that while also seeing that the ecosystem is getting stronger and that some of my initial concerns were addressed, which is, the Bitcoin versus Bitcoin Cash and other things like that. And just seeing kind of, risk reduced and opportunities increased, I was like, okay, now the risk reward in my view, strongly favors Bitcoin.
Yeah. No, we do videos every year on the 4 year super cycle, the halving, and you overlay the Wall Street cheat sheet, the emotional cycle, and because you've
Yeah,
got the 4 year nature of it, as well as that cycle where people hear about their friends making money, and that's why it overlaps and it fits and it kind of grows exponentially, a little bit like Moore's law as well. So it's just this perfect combination of things that you can represent beautifully with these different charts and graphics and projections. And I think that's going to hold true for at least one more cycle. I'm not sure what happens thereafter because we're starting to get to some pretty large market caps. But yeah, I just love the fact that some very smart, legitimate people from all walks of life. So you've got the technology guys that are smart, that are bullish on it because of the tech they can do, like Microsoft's building a digital identity system on Bitcoin. Others are building on Ethereum. But then you've got the economists, investors. There's so many different reasons. People that want to protect their wealth from hyperinflation, people that want to circumvent capital controls. And I think people are starting to understand that once you've got all that money and all those factors, then now it's not taboo. There's less career risk. Paul Tudor Jones, Stan Druckenmiller. I was joking with Mike Novogratz the other day that he's out there and he's a crypto guy, but now you've got Lyn and Raul and everyone out there. So I just think that that makes it very legitimate in the eyes of these people that are respected and widely followed. So that's where I think we stand on the precipice of the bull market. But yeah,
that's one thing I try to do with my July article is, write towards a mainstream investor or even an institutional investor, and kind of make the case for having a non-zero Bitcoin position. So, because a lot of the writing I see in the Bitcoin community is for other Bitcoiners, and so it's like, okay, how can I just translate this as though I'm making the case for a stock, right? So I write these long reports on a stock and why I think the stock's good, what are the risks. Same thing with gold. And it's like, okay, let me just do one of these massive articles on Bitcoin and say, here's all the evidence that I think is going to do very well. And here's some of the risks, and here's some of the concerns that I know you're going to ask, so let me address those, and just kind of lay this out in a way that someone that's running money, or someone that say they have $1 million retirement portfolio, and they say, okay, I think I can put 1 or 2% into this, or I think I can have a non-zero Bitcoin position and go from there. And so that's kind of how my article was addressed.
And I think well, that's why I'm so passionate about education. But I just think it's a matter of time and education, and we're starting to see that now because, as you said, I think Raul and others sold around the forks at the time, and there was a lot of panic. And most people would have no idea that there's 100 Bitcoin forks, but you don't hear about them, and they make Bitcoin stronger, and it's the anti-fragile nature. The energy wasting argument, it's becoming more and more renewable, and in some ways it's even driving and helping the renewable space. The security, the hash rate, it's getting more decentralized. It's just everything is kind of being worked out, or the problems are being solved. We do need to scale Bitcoin, but I think that Bitcoin does not need to change and to be very successful. It can improve and become more of a payments layer, but the idea that it's this money and currency is, hey, it's a multi-trillion-dollar idea without changing at all.
Yeah, I think so, and that's how I approach it, is analyzing its network effect like I would any other kind of entity. So if I'm analyzing a stock, I would kind of like how Warren Buffett always said, look for economic moats, companies that kind of become so entrenched that it's hard for competitors to touch them. And so when I analyzed Bitcoin in 2017, I was kind of shaky with the moat. I was like, okay, so I know that forks are always possible, but it's like, okay, will any of these forks actually split the community and dilute the community? And so there was kind of some questions around there, especially if you're approaching it from someone who's not already deep in the digital asset space, and saying, is this an asset that I want to put money into?
Mm.
But then in early 2020, I can say, okay, now the network effect is more clearly strengthened, right? So the market cap of Bitcoin compared to any other individual big cryptocurrency that's trying to be money is very substantial, and that basically they've run away with the security advantage, kind of a firm monetary policy, the developer community, the decentralization, like all these different variables are so far, kind of removed from some of their closest competitors, that the network effect here does justify, that this one cryptocurrency, as far as the specific goal of being kind of like digital gold, is likely to do very well in that. So that was
Yeah.
kind of my bull thesis for going in.
And just quickly, Lyn, you've been very generous with your time. So, two questions. Are you in the camp that the rehypothecation and the futures markets that have suppressed gold and silver to some degree, either intentionally or not? And are you worried that that can happen with Bitcoin at all?
It's something I'm aware of. So any asset that has a very high stock to flow ratio is theoretically vulnerable to that. So you don't really see that with something like the copper market, because most copper that is produced gets used that year. So you don't have like a large kind of 50 years of copper storage somewhere. But when you have an element like gold, and to a lesser extent silver, it's more easy to manipulate, because the stock to flow ratio is so high. So you can build these huge kind of derivative markets over top of the more limited physical supply.
Yeah.
And with Bitcoins, as a monetary asset, it is also theoretically susceptible to that sort of same thing.
Mm.
However, because Bitcoin is easier to settle, so the way that the gold and silver markets are able to sustain that kind of rehypothecation issue is that they're inherently hard to settle. So if you're exchanging 6 or 7 figures in gold, that whole process. I mean, if you read someone's account of what it's like to get physical delivery
Yeah.
of that, it's a crazy process, and that's almost by design. They want to make it hard to settle, so that these are just cash settled, and it's kind of this big kind of paper casino over top of a much more scarce resource.
Yeah.
But Bitcoin, because it's so easy to settle, that's the case I've seen from people that don't think it'll be an issue, and I think it's logical that because it's easier to settle, there'd be less
Yeah.
proliferation of all of these other kind of cash settled markets. But we'll see what happens.
Yeah. And finally, I mean, I tell people that Bitcoin is the king and the currency and the money. I'm also very bullish because I think Ethereum and the idea of everything that's wrong with the internet and big tech, and we spoke about decentralization. I think there's a huge opportunity there for a technology play, a new internet system. Do you have any? Have you started that journey down that rabbit hole, or you plan on doing that? Are you interested in that as well?
So I think the whole space is really fascinating. I think smart contracts can disrupt a lot of industries. So I do like to see all the innovation that's happening in that space. For me personally, the one that I want to hold as a token is Bitcoin.
Yeah.
But if I was running a private equity fund and I could invest in different companies, I think there are companies doing really good work on the Ethereum network, for example. I think that there are these other kind of protocols that I think are probably going to do pretty well and disrupt certain things.
Yeah.
But as an investor that just wants to have kind of a store of value asset,
Yes.
I've kind of focused entirely on Bitcoin in that regard. So I
Absolutely.
would leave kind of the going down into the small caps to someone like you that has more focus to specialize and pick out these individual projects that have a lot of promise.
Yeah. And cop the trolling, cop the trolling when it goes wrong as well. um, Okay, that's been fantastic, Lyn. I think, well, I've learned so much. It's hopefully a conversation that really resonates with ordinary investors that are non-crypto, as well as the crypto crowd, to understand why it's so important and what is going on in the treasury market, the world reserve currency market. So I'll put the links to Lyn's work. She does brilliant free stuff and some premium stuff as well down below, and follow on Twitter as well. But any final thoughts for people, Lyn?
I know. I think we covered so many different things. I just think, people have to keep an open mind. Some of the things that, could happen over the next 5 years could be stuff we haven't seen for decades just because we're kind of, we're at probably the tail end of a long-term debt cycle rather than a normal kind of business cycle. So I think there's going to be an unusual environment, and some of the preconceptions you have might not be, what works out. So I would just keep an open mind as far as research is concerned.
I think 2020 has shown that to everyone as well. Expect the unexpected. So,
Yep.
yeah, Lyn, that's been awesome. I really appreciate your time. I hope you guys have enjoyed that one. Give Lyn a follow, and we'll have to catch up again in future.
Yep. Thanks for having me.
Thanks, guys.